We have Warren Hogan, chief economist at ANZ Bank, and he joins us from Sydney this morning. Good Monday to you, Warren.
Good morning, Susan.
Okay, so tickle test, not stress test. What do you make of these results?
Well, I think the general consensus is that they weren't strong enough. The most important fact was that they didn't include a sovereign default in Europe as part of the stress. So that's where we label it a tickle test, because really it was just not strict enough, not firm enough, and of course, most importantly, not addressing the primary risk facing the European banking system right now, and that's a default from Greece.
Okay, but despite that, we still had Spain and Italian banks coming up on top. But some would think that they probably are the weakest of the bunch, but no, not the case.
Yeah, well, individual banks have all got, the data all comes from right within these banks, so there's a lot of non-public information there, so there's always going to be a few surprises. But I think the general idea here is that that 8 of the 91 banks is too low a number. That the market was thinking something more like 20 or 25 banks would fail these tests, and they weren't strict enough.
Okay, so it looks like a $3.5 billion shortfall was the latest tally from these stress tests. But some are taking, I guess, more surprisingly, the fact that there was a German bank involved in not releasing the results and possibly not being able to pass what you call these tickle tests.
Yeah, well, it doesn't seem to have disrupted the market too much, but that's the insinuation is that they wouldn't pass, but we just don't know. So, I mean, the market's putting this to the side. I think the key is going to be the European leaders meeting this week, and a decision on the next steps for Greece in particular needs to be made. And we are right at a critical phase here, because Spain and Italy are now starting to come into play for markets, and the worst case scenario for Europe and indeed for the global financial system would be the Italian and Spanish markets getting impacted the way we've seen in Greece and Portugal and Ireland.
Okay, well, Warren, what's ANZ's thoughts right now on the European sovereign debt crisis? We have Marty Feldstein, who used to head up the National Economic Council. He's already said that he's expecting a Greek default, and Ireland he's expecting to go next as well.
There's three stakeholders in this. That's the broad European taxpayer, the taxpayers of the country involved, in this case the Greek taxpayer, and there's the bondholders. And quite clearly history shows that everyone has to contribute here. You can't just rely on the Greek taxpayer or the German taxpayer, for example, and the bondholder has to play a role. So some sort of default/restructuring, a credible fiscal package that tightens things up in Greece, as well as some sort of money from the broader European Union, are all going to be required in this. It's just whether or not the Europeans can pull themselves together and take that approach. The ECB's President Trichet said on the weekend that they still stand by their view that the bondholders shouldn't play a role in this.
Okay, well, you know, last week we saw basically U.S. markets being hammered with a combination of the European sovereign debt crisis and also these debt talks that don't seem to be yielding any agreement so far between the two parties. So in your opinion, what's a bigger issue right now? What's happening in Europe and what's taking place in the U.S.?
Well, we saw the S&P send a shot across the bows following Moody's, and they put the US government on negative credit watch, which is actually an immediate concern. They said that there's a 1 in 2 chance of a downgrade in the next 90 days, which is quite clear to say that if you do not get this debt ceiling raised, we will downgrade you. The market again thinks that something will be pulled together at the last minute, and we are really into the last minutes here. We've only got a few weeks. But if there was a problem here and the US Treasury market got heavily impacted, specifically if there are holders of US government bonds that can't hold anything but AAAs and therefore have to sell those government bonds of the US, that could cause long-term interest rates to go up quite a lot. And of course that's the sort of financial stress you don't want to see in Europe or anywhere around the world at the moment, is rising long-term interest rates. So the US problem is unlikely to eventuate. We think that the US Congress and the President will come up with a deal, but if it didn't, then that would be quite severe.
All right, Warren, thanks for sharing your thoughts on this Monday morning. Good to see you. Warren Hogan, chief economist at ANZ Bank, joining us from Sydney.